Good evening. It's May 6th, Friday, 8:20 p.m. Welcome to episode 43, No Mercy Sell-Off. Good evening to you, Wawi.
Good evening, Mark.
And good evening to our loyal listeners. I hope everyone is doing just fine. This is your host, Mark Yu.
And Wawi Santos.
And welcome to the Mark Yu and Wawi Show. A disclosure, this show is made for sharing information purposes only and not to be considered an investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you guys for your hard work. For those who have missed our previous episode, Palpable Fear, we discussed Nasdaq's worst monthly performance since 2008. Big tech earnings, companies Amazon, Apple, Facebook, and Google, their earnings performance, and the big oil companies, Exxon and Chevron. So if you guys want to listen to that, you might want to listen to the previous episode after this one. So on this episode, we're gonna start off with our weekly sentiments review. So screenshot right here, published just as when the market closed as of Financial Times publishing. U.S. stocks suffer longest streak of weekly losses in over a decade. Equities close lower after days of tumultuous trading surrounding central bank tightening. So for those who are not aware, central bank or Federal Reserve, specifically Jerome Powell himself, has finally increased the rate by 50 basis points as of Wednesday. And initially, actually, the market reacted positively. Dow Jones even gaining almost 1,000 points, right, Wawi, on that day itself?
Yes, it did. It reacted positively.
Yes, and then come Thursday, the sell-off has begun. Well, it's kind of started since the start of the year, but Thursday's sell-off was quite severe. It ultimately erased Wednesday's gain, whatever we had right after the federal announcement, and then some more. And today's Friday, we still, today the market kind of reacted at least a little bit flat. So we're going to review the performance of the stock markets for this past 5 days in a second. So for the sentiments, we take a look at the American Association of Individual Investors. They take surveys of individual investors on a weekly basis to determine if investors are feeling bullish, meaning if they think that the stock market will be up in the next 6 months, or bearish, meaning the opposite, or at least neutral. So as of May 4th, bullish investors has improved. The sentiment has improved from 16.4 last week. We're at 26.9%. So this is right when the Federal Reserve announced their rate hike. That meaning to say, the bounce that happened on that day quite reflected the survey sentiment, which were at least 10 percentage points more bullish than previous week. And bearish, still a little high at 52.9%, almost 23% more than the historical average. So for the volatility index, this kind of measures the ups and downs of the S&P 500. It's actually down 11% for the past 5 days. Meanwhile, the volatility index for the Nasdaq, which is a VXN, as I'm pulling it up right here. So this measures the up and down movement of the big tech stocks or the Nasdaq index. It's also down for the past 5 days, negative 5.48%. Interestingly. So it means that we have received actually less gyration for the past 5 days. This will kind of like reflect the overall performance of the index, which is coming up shortly. We'll see if the index has stayed flat or just moved a little bit for the past 5 days, despite the heavy sell-off that just happened. The fear and greed index, obviously we're at fear as the sell-off has been happening for the past 5 days. 1 week before we were at 27. This week we're at 31. Market momentum, we're in extreme fear as well. The put call options, tail that wags the dog, we are at extreme fear. People are buying more put than call at this point of time. Actually, it's the highest at its highest point since about May of last year. So people are definitely being bearish right now. So if you interestingly, Huawei, if we're gonna look at the past 5 days, which is this week, there hasn't been much change. I mean, it's still down overall, but the S&P 500 itself, it's almost negative 0.08 or almost neutral for the past 5 days, believe it or not, despite the sell-off in the past couple of days. Dow Jones is almost flat as well, negative 0.2. It's only the tech stocks, again, being pummeled down 1.16% for the past 5 days. For the past week, the sectors that have outperformed are energy, utilities, and communication services. The rest are down in the red, led by consumer cyclical, real estate, interestingly, and consumer defensive. So some say that in a rising rate environment, real estate actually performed well. But this week, despite the Fed rate hike, it performed terribly. Meanwhile, energy, the outperforming group since the start of the year, is still the king of performance this week. It's up 7.4%, while utilities is barely inching into 1 percentage point return. Since the start of the year, we're obviously looking at only one sector. Okay, so last week, Huawei, I think we saw utilities gaining some, providing some gains to its investors, but since this week's sell-off, there's only one sector that has returned positively to its investors, which is the energy sector, up 35.7%. The rest, led by consumer cyclical and technology, are down the drain. Technology itself is down 24.2% as a sector, more than a bear market at this point in time. How are you handling this, Huawei, at this point in time? Seeing the portfolio is pretty much in a bad shape.
Yeah, so I like the group members know, I'm heavy on the growth stocks.
Mhm.
So, but I'm still agile and I'm rebalancing my portfolio. And I have recently acquired BP, um,
Mhm.
BP oil. So, but looking at the perspective of 1 year, percentage change on sector performance, we're seeing consumer staples is second to energy at 11.76%, and utilities at 10.38%. So still keep your eye on those um, sectors. As you know, energy is leading. So don't forget about consumer staples and
Mhm. There's
utility
some of the
sectors.
things that we typically require on a daily basis, regardless what the economic does. We still have to pay our bills,
And
utility
eat.
bills, and eat, obviously, consumer staples. Uh, well, here's an interesting article from Bloomberg. This was just published today, this morning. Billions in wrong way ETF bets placed just before Thursday rout. Largest VIX volatility fund was ditched before biggest jump in 5 months. Investors had bought ARK, ARKK, TQQQ, among other funds before slump. So these people pulled their money on these stocks just before the sell-off that just happened. So that's quite a loss right there if we're gonna look at its performance since the Thursday. So diving in just before the sell-off, I'm pretty sure people are now holding these investments. Hopefully they're with a mind of like holding them for the long term and not just for an easy flip, because it's gonna take a while to recover. A 15% loss, let's just say, would make you from $100 would put you down to 85, and you would need at least about 18% to break even. So losing 15%, for example, would require you almost 20% to gain back that loss. So a big,
Mhm.
huge drop in the company's stock nowadays is not that far from happening, as we have succeeded witness, right? While we it all started with Netflix. Netflix,
Mhm.
one of the big tech fang stocks, just collapse 30-40% January, and then the first quarter came out again this April, and then it sell off again almost 40%. So they're hitting the big tech right now. It's not far from happening. So it's quite dangerous. Facebook again, another perfect example. um Amazon
Amazon.
quite suffered a huge dip. Well, it's not like losing 40%, but its stock price was at 3,000, almost $3,000 at one day. It fell to 2,400, about 15% loss. But that's a huge chunk of investor money evaporated into thin air. So a lot of selling, a lot of price collapse.
Yeah,
So, mhm,
and interestingly, like I said in the group, we're seeing a lot of selling before the earnings report.
mhm,
So people are scared of growth stocks. You know, they're scared of inflation, and they're moving away from growth stocks.
definitely.
Um, Speaking of large inflows before the market downturn,
Mhm.
there was a reported like 430 million or something going into ARKK
Yes.
about 3 days ago,
Mhm.
and
That's quite a huge
I
fund flow. Mhm.
caught wind of that. So I guess they were just trying to time it. If they bought it today, they probably may have a better position. But
Exactly.
like you said, if they will hold it for a while, then maybe, right? Maybe they'll see some results,
Yeah.
positive results.
Yeah. Just today alone, ARC is down 4%. And if they
Mhm.
have bought it, let's just say Wednesday, let's just say maybe Wednesday morning. If they had bought it on Wednesday morning, they'll be down 8.26% already. So lots of people getting stuck with possible long-term positions because of these major purchases.
Mhm.
So according to the fund flows provided by Reuters, global bond funds post massive outflows in the week to May 4. So soaring inflation doesn't help it. People are still selling the bonds, dumping them for the fifth straight week of net sell-off on bonds. Meanwhile, if we're gonna take a look at the stock fund flows, weekly outflows from global stock or equity funds east to $1.79 billion. So still, people are selling out of global stock or equity funds, 1.8 billion worth for this week.
Mhm.
But this is the lowest for the past 4 weeks. So at 1.8 billion, that's quite a huge chunk still, but it's the lowest kind of like average for the past 4 weeks. By sector, financials and tech saw a sell-off of $634 million and 483 million respectively. Meanwhile, like you said, Huawei, utilities and consumer staples are the ones receiving inflows from investors. They've received 497 million and 457 million respectively. The money market, which is like AKA cash on the sidelines, has seen outflows of nearly $11 billion after attracting at least 51.72 billion the prior week. So people are starting to locate those big money, billions of dollars on hanging on the sidelines, putting them into work. So now we have the price action, which we're gonna tackle company by company, whichever time allows this evening, because it's already late. So we're looking at some companies that have released their earnings this week. So we're continuing that marathon, earnings marathon. So Shopify in this chart is the worst performing stock. It's down 72% since the start of the year. Wayfair. These are online shops, by the way, that we're going to be looking at closer. Wayfair is down 66%. I remember while we in our first episode ever or second that you were talking about Wayfair too, that you have missed the boat on this one. But I think the boat is coming back. The boat is coming back for a possible second trip. $66 a share, Wowie. Since the start of the year, it's down 66%. Wow, what a coincidence.
So
And
it's back. It's back on shore.
back on shore.
But
Needs
I'll
some
wait.
repair.
Yeah, I'll wait.
Yeah. At one point last year was $325 a share. It has lost almost 80%. Crazy drop. We're gonna take a look at its price, its earnings performance in a little bit. Followed by Etsy. Etsy is down 59%. Followed by Lyft, losing 54%, losing more than half of its value. DoorDash wants to make it even after losing 50% of its value since the start of the year. Uber almost losing 41%. Of course, Facebook losing nearly 40%. Amazon is down 33%. eBay is down 27%. Google in the bear market down 20%. Whew, these companies are feeling the heat, definitely. Shopify, this company I remember was trading around $1,600 at one point when I think ARK Investments, it's herself, Kathy Wood, was touting its shares. Now it's down. Even today alone, it's down almost 9%. Oh my gosh, there's just sell-off everywhere that we see in tech. It's $377 a share, down 9% today. It's down 72% since the start of the year. Look at that. It was at 1600. I was right. It was about $1,681 a share back in November, just November of last year. Oh my. So if we're going to take a look at its earnings, hopefully I got my Seeking Alpha pulled up here. Seeking Alpha provides free resources for those who are interested, who wants to, closely monitor these companies. So Shopify, it's down to its near to its 1-year low. Its price to earnings for next year, it's quite expensive actually. It's at 396 times estimated earnings for next year. That's quite a price right there to pay, even with the sell-off already, compared to Amazon, which is I think Amazon right now, I don't want to postpone it, so let me just take a look at Amazon's forward price to earnings at this point in time. Give me just a second. Amazon is forward price to earnings 67 times. So at 396 times, you're definitely paying still a high price for Shopify. So don't be mistaken here. I'm not recommending to sell its shares, but it may look otherwise a discount at this point in time. So according to Seeking Alpha, Shopify missed its earnings estimates and also missed its revenue estimates. Therefore, this was released yesterday morning. So therefore, the sell-off in the stocks and include the broader market sell-off sentiment that just came after the Fed increased their their rates. So it missed both earnings and revenue estimates. So if we're going to take a look at its press release, we usually bypass the quotes and quotations unless otherwise we have extra time. But if we're going to take a look at its revenue, so it didn't meet Wall Street estimates, but let's see if it at least grew. So Shopify actually grew its revenue from $988 million a share. I mean, 988 millions in sale to 1.2 billion in sales. So it grew. Meanwhile, here's a red mark right here. From $1.26 billion in profits last year, it registered 1.47 billion in losses this quarter. Let's see what the culprit is. Looks like they've paid a lot more for their merchant solutions and subscriptions, leading to, well, they just still maintain their profitability, top profit, gross profit, but their operating expenses almost doubled. That's why. So their expenses and their staff added almost $40 million. Research almost doubled. Sales almost doubled. Transaction and loan losses doubled. So that gave them a big loss.
And
So
so,
mhm,
how old is this company? Let's see. Is it 5 years
Shopify,
old?
that I'm not sure.
I don't, yeah. Well, if you look at it, since its IPO, it's
Mhm.
gone up like 1,369%. But for this year, for 1 year, it's lost 65 percent of its returns uh, in 1 year. Interesting.
So it's quite, it has lost a ton of shareholder investments for sure.
And its short interest is up at 4.39%.
Hmm.
I guess a lot of these growth stocks are being shorted at this time. For
Hmm.
sure, for sure.
Yeah, but looking at this balance sheet as well, it has nearly, let's add this up, 4.8 plus 2.45. They have about 7.25 billion in cash while having about 19.3 plus. We're doing this on the fly, folks. So this is what you're witnessing here is how we take a look at companies. It has about 1.2 billion in debt. So they're pretty much liquid at this point in time, at least. I don't see them suffering any major financial breakdown if interest rates keep rising. So that's Shopify for you.
And
Next, mhm,
I think customers still like Shopify for their service
mhm.
and easy turnkey solutions.
Yeah,
Uh,
it's an alternate for Amazon, as one would like to say. Yeah. So Wayfair, the next company we have on the list. So, oh, Shopify was founded on 2006, 16 years ago in Ontario, Canada.
mm.
So Wayfair, meanwhile, is down 66%. Um, so we're gonna take a look at its earnings or performance so far. Wayfair is down 1.9% today at 66 bucks a share. It's close to its 1 year low at 56 a share, about $10 more. $10 less from today would reach the 1 year low. It doesn't have projected earnings for next year, so that's kind of a red flag. So it doesn't have any forward to earnings ratio. If we're gonna take a look at its performance, its CFO, finance chief, is to retire next year. It says
Oh,
Wayfair, they missed earnings estimate while beating the revenue estimates or sales estimate by 10 million. So we're gonna take a look at its filings. Boom, 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 boom. Yeah, I'm skipping the key metrics right there.
yeah. From what I can see here, it's a $7 billion market cap.
Mhm,
It has 16,681 employees.
mhm.
Um, so far, I think it says here that they had like a 28.41% gross margin, but
Okay.
it's a high short interest on it right now at 18.09
Mhm. That's
with a beta of 2.88.
short interest is the people or investors who are betting that the company will go, the stock price would go down. So the higher, it means that more people have a higher conviction that the company's stock would go down. So for its revenue, look at that. It actually lost. Despite beating the estimates in revenue, it actually dipped from 3.47 billion last quarter last year. I mean, first quarter last year, it dipped to 2.99 billion. So they lost almost 5 billion in sales. I don't know, not 5 billion, sorry. Uh 3.5 minus 3. So they lost about 500 million in sales instead of growing. So this is kind of a warning right here, because we also saw Amazon experiencing some slowdown in its e-commerce business. So people are not that much into buying online stuff now at Wayfair, now that we have slowly, at least reopened more furniture stores. And Wayfair, I don't think has any like brick and mortar, right, Wowie? They're only
No,
exclusively online.
as far as I know, yeah, it's purely online.
So they lost 500 million sales compared to last year. Definitely a slowdown right there.
Probably
It's
from competition.
from brick and mortar, I think, my opinion. Meanwhile, their total operating expenses grew by 200 million, giving them a loss of about $300 million in loss compared to 8 million profit last year. So despite the reopening in the first quarter of last year, they generated about just $18 million. And then this year, with more competition online and slowing down of customer purchases, now that brick and mortars are open, they registered a loss. So if we're going to take a look at its balance sheet, let's see if this company would stay afloat. They have about nearly 2 billion in cash, while they already have 3 billion in debt, long-term debt, including liabilities. It would be $3.8 billion. So this
Well,
company is definitely in debt at this point in time.
well, with my personal experience with Wayfair and shopping for furnitures,
Mm-hmm.
we're ending up buying stuff from Amazon
Mm-hmm.
when it comes to pricing furnitures. Unfortunately, um, so it's losing the pricing war. It looks like,
Mm-hmm.
uh, unless it can scale up some more. Looks like it will depend on May 18, right? So when we get the next release of new residential construction, what's on tap for these furniture companies?
It could be correlated, as people do like online shopping. Yep. All right. For the next one, we have Etsy, whose shares are down 59, almost 59% since the start of the year.
Oh, I have
So,
that stock.
oh, you do have Etsy. Oh, interesting. So yeah, Etsy alone, the today alone is down 5%. It's at $86 a share. It's close, $5 less than today's stock price. It will be trading at its 1 year low. Forward price to earnings, it's at 24 times. So I would say anything above 19 right now, it's still a little pricey compared to the broader market. Short interest is 9.7%. Market capitalization, or the value of the entire company, is $13 billion. So if we're going to take a look at its performance, this online store, let's see, they released their earnings on Wednesday. So they beat their earnings estimates and they beat their revenue estimates. So they beat both. Either way, Etsy spirals lower after weak guidance, according to Seeking Alpha. So let's see what's up with their report. Here we go. Let's look at the hard numbers. Financials. That's what we're attracted to look at. So Etsy for the first quarter, revenue grew by 29 million almost, at least. So at least for their business, it grew. The sales, the top line grew. Operating expenses definitely was added more, 70 million more. And their bottom line almost shaved in half. So 86 over 143.7. They shaved by almost 40% off. So even with a beat, the company suffered a lot. The company experienced a lot less profitability this quarter. Their cash situation, meanwhile, is almost $1 billion in cash. while their obligations and their debt, let's take a look at that. Ooh, they have nearly 2.3 billion in long-term debt, plus 100 million here, 2.4 billion. Uh, let's just say about 2.4 billion in debt with nearly 1 billion in cash. So they're pretty much leveraged as well. So I would say, they're pretty leveraged. They're spending more in their expenses, resulting in less profitability. So at least for some reason they've been able to grow their sales at this point in time. I wonder if so it's Etsy. So probably sellers in that platform, as to my knowledge, have they sell their own stuff like craftsmanship, right? So
Yeah.
I think at least over from that point of view, or from that seller's point of view, they have the power to dictate what price they're gonna sell their craft. So, but
That's their niche.
that's a niche,
Mhm. It can be seasonal too, right? So
right?
Etsy can be seasonal, right? A lot of these crafts, tend to demand for them can go up during certain occasions.
Right,
So,
during holidays and stuff.
mhm. And again, it's another one of those companies with a lot of short interest at 12%.
12%, yeah. All right, next company we're gonna take a look at is eBay. So eBay is down nearly 27% since the start of the year.
Not as
So,
bad as the others.
mhm. Surviving, but still, that's a huge drop. Amazon, well, it's down 30, right? So eBay at least performed. Today it's up 1.6%,
Yes, it
48.8% a
is.
share. But take a look at this, just a dollar less from here. It will be trading at its 1-year low. So
Oh, wow.
for forward earnings ratio, it's 12 times. So it's quite cheap, actually. I'm not
Mm.
saying to buy this stock, but it's quite cheap. Um, Short interest, 3.5%. Capitalization is $30 billion for eBay. So let's see
And
what
it's
happened in its earnings report. Mhm.
yeah, go ahead. I was just gonna state the beta. It's like 1.15, so it's kind of average. And
So
gross
mhm,
margin 73.38%. Whoa, short interest is up 19%.
19%. Okay. Yeah, from 3.5% here in Seeking Alpha. You're looking at Fidelity info?
Uh, yeah, I'm looking at. I subscribe to Motley Fool, so I'm
Mm.
looking at what they have here on their overview.
Oh, okay. Yeah. For their report, which they came out on Wednesday, they reported they beat earnings forecast, um, better than expected earnings. Revenue slipped 6%, and they issued soft guidance. So I'm not sure if they beat actually the sales or revenue expectations. Might worth a click right here. It's taking its time. So revenue beats. Okay, so eBay actually has beaten both earnings and revenue Wall Street estimates. So if we're gonna take a look at its filing, let's take a closer look.
Well, we may have found a jewel
Mhm.
in this volatile um, market.
Yeah. Well, let's see. eBay actually lost some sales from $2.6 billion. It's now 2.448 billion for this past quarter. So they lost about 200 million in sales. It's their operating expenses have actually dipped a little bit. So that's a good sign. They're able to maintain their expenses. Let's see the bottom line. Oh my. So they still huge quite suffered quite a huge loss here. $1.34 billion compared
Wow.
to 641 million in profits last year. So if we're gonna take a look at where did they suffer, because they I thought they kind of like managed their expenses pretty good, but they lost 2.29 billion on equity investments. So I'm not sure what that is. They probably
Yeah.
lost a good amount in one of their investments. Company's
Interesting.
cash. I think we just saw it right here. Uh, eh, where is it though? Change in fair value of equity investments in Adevinta and G
What is?
Market.
I wonder what that is.
It's Adevinta. Leading online classifieds.
Mm,
So it's we are global classified specialists with online marketplaces in 15 countries. It's a company headquartered in Norway. So I guess that's how they lost their money to nearly 3 billion. I'm pretty sure it's not that loan investment right there, but it's almost $1 billion in one of their right here in the $1.6 billion loss. So quite interesting. And we're going to slide up to their balance sheet, take a look at its cash situation. It's 3.77 billion plus 1.8 billion. $5.57 billion in cash while having 1.8 plus 400, 1.8 plus 0.48 plus 6.58. Oh, 8.86 billion in debt. So quite a leveraged company right here that we're looking at. So yeah, I'm not saying not to buy this company, but valuation wise, it's okay. It's not a perfect company. I'd rather have a company that has a lot less debt and still growing
mm,
revenue. That's quite a discovery right there at the Vinta. Interesting.
mm-hmm.
So yeah, next company we're gonna take a look at is Lyft. So ride-hailing companies. At this point in time, in hindsight, we were thinking that reopening plays such as Lyft, Uber, and Airbnb should be rattling high because people are going back to work, spending, making trips.
Mm-hmm.
So anyhow, Lyft lost 54% of its stock price since the start of the year. So let's see its report, its actual report. So Lyft is trading down. It's down almost 7% today alone. It's at $20 a share, $20.50. It's very close to its 1 year low of $19.59 a share. Its forward earnings, it's 81 times. So quite pricey at this point in time, despite the heavy drop in its stock price. Short
Mm-hmm.
interest is 8.2%. Market cap, it's $10.72 billion. So looking at its report, disappointing outlook. Lyft earnings miss while sales beat. So it beats its revenue while it missed its earnings estimates. So if we're going to take a closer look at its actual figures. So Lyft, they actually generated a good amount of increase in their revenue, nearly $200 million more compared to last year. Meanwhile, their expenses also only increased by $50 million, which is pretty good. Meanwhile, their profits, they don't even have any profits at this point in time. Last year, they lost 427 million. This quarter, they lost almost 200 million. So they're still burning a lot of cash at this point in time. Their cash, actually, they have about 2.2 billion in cash, while they have about 250, 900, almost $1 billion in debt. So at least able to float for a few more months, I would say, if they keep on,
Mm-hmm.
delivering these type of losses. So they're deeply in the red. both in stock price and company performance. So it will only take a visionary, at least, or those who are really positive in ride sharing, that Lyft is a good buy at this point in time. But myself would not be one of them. How
Mhm.
about you, Awi? What do you think on Lyft?
Well, we gotta compare it to Uber.
Mm-hmm. Yep. We're gonna take a look at Uber right now. Let's see. So Uber itself, it's down a little less, but it's down still quite a good amount, 40% since the start of the year. Let's see how it performed. Its report today, Uber lost 2.8%. It's at $26 a share. It's $2 less from this, would be close to its 1-year low at $24.75 a share. It doesn't have any forward earnings, meaning it doesn't. Wall Street doesn't see any profitability by next year. Market cap is $57.6 billion, regardless. Let's see its performance. So Uber, it has beaten its sales expectations, while let's see its earnings performance. What is may not be comparable to consensus of negative? So actually, Uber didn't meet earnings estimates, but they did beat revenue estimates. So let's see its actual numbers. No sugarcoating here. Oh my, this is quite troublesome for Uber. Look at that, Huawei. From 6.85 billion last year, the company only registered 2.9 billion in sales for the past 3 months. That's more than half. That's a big drop from last year. It's quite worrisome at this point in time, just looking at its top line.
Yeah.
Total cost, obviously, if you have less business, you have less cost, right, Huawei?
Yes. So I wonder if their number of drivers have increased because I saw that Lyft's number of drivers have increased from last year, late last year. So
Let's
let's
see.
see.
Drivers, because of the expenses you're looking at, or
Well, the more drivers they have, the more business
expenses? Oh, the more business. Yeah,
yeah.
that's true. But we're gonna take a look at the. Let's see if they have revealed the information. Classification, drivers.
See if I can.
It's more of the
Eh,
unions they're referring to if they say drivers. But yeah, let's probably go back here to the profit section. Yeah. So Uber. Well, once you found the numbers, maybe you could share it here. Yeah, but we're gonna take a look at the bottom line for Uber. From almost $6 billion in losses last year. Oh my gosh, $6 billion in losses. It's down to 108 million in losses this year. At least they were able to tamper down the losses while we at this point in time.
Oh, well, it looks like they're having trouble keeping drivers, so they're trying to give them more incentives. But I
Oh
think
my.
I just heard
Okay.
an interview
Mhm.
on Bloomberg this today that that the CEO is not going to offer any new incentives
Well,
for
no
Uber
new
drivers.
incentives. Yeah, because they're not generating any business. They just lost almost half of their business. It's crazy. More than half.
So we'll
6.85
see.
down to 2.9 billion. That's worrisome right there. That's a red flag, a big red flag.
So
Um,
Lyft may be in a better position
yeah,
since they,
Lyft actually grew, right? If we're gonna
yes.
Lyft actually grew their revenue. Let me see. Let me double check.
Mhm.
Lyft grew their revenue almost $200 million.
That's quite a surprise. I
Mm-hmm.
didn't expect that.
Lyft has better standing actually at this point in time. 800 million dollars compared to, well, Uber of course has about more than that, 2.9 billion in sales, but it's quite a drop.
Mhm.
Cash. Let's look at the cash. 4.8 billion in cash with about, forget it. Wow, more than $10 billion in debt. Uber is definitely a cash trap at this point in time. Losses after losses, and then a lot more money coming out to pay for interest expense. $115 million actually came out from them to pay their debt this quarter alone. With how much in cash? 4.8 billion. Well, divide by 100, they could last at least a few more years if this trend keeps up, but without taking any debt or any dilution of shares. So Uber in not so good position in my opinion right here. So last one that we're gonna take a look at, the reopening place, is Airbnb. So if we're gonna take a look at Airbnb. Oh no, wait, I think we skipped on one. How about DoorDash? Yeah. Let's look at DoorDash. So DoorDash is down 50.39% since the start of the year. So DoorDash, it's down 1.4% today at $72 a share. About $10 lower from here. We're at 1-year low again. Price to forward earnings is 228 times. It's quite pricey still. Market cap of $27.8 billion. So DoorDash, they missed earnings estimates while they beat sales estimates. So if we're going to take a look at its numbers, DoorDash, oh wow, similar to Uber, Wowie. They nearly lost almost 500 million in sales. So these companies are shrinking as we speak. They're shrinking, at least as of this first quarter. A troublesome picture right there for the gig economy, because these are like they not even like hire their drivers or deliverers. What do you call them? As full-time workers, but gig workers. So they lost a good amount in sales, almost $500 million in sales, while their operating expenses also dipped about $500,000. So bottom line, they're still losing money. 110 million loss for this quarter compared to 167 million loss last year. Let's take a look at its cash position. DoorDash at least is quite liquid. They have 3.7 billion in cash, 3.7, while they don't have any debt. Let me make sure of that though. Yep, I don't see any debt except for 373 million. They're pretty much liquid at this point in time. They could probably survive this downfall. But man, they just lost 400 million in sales. Now back at around 100 billion, 1 billion. So that's quite a troublesome picture right there. So that's 2 out of 3. That's quite troublesome, right, Wawi?
I think so. People are starting to eat in restaurants again and fast food chains. So the demand for, I don't know. I'm just questioning the demand for home delivery for that.
Yes.
Is gonna increase over time.
Expenses, higher gas price, no incentives from Uber, more competition, more reopening, back to normal stuff. So I think it's gonna be hard for these companies, honestly, in my opinion. But anything can change. So we'll see. So lastly, we're going to take a look at Airbnb. Actually, Airbnb is not pulled up in this chart. So if we're going to take a look at its 1-year performance, it's down to $135 a share. Today alone, it's down 5%. Oh my, sell off. I remember having this company at 140 and I sold around 180. That little tiny piece, but that was like just a test buy, I'm just practicing with it. 135 bucks a share. It's down 21% since the start of the year. So if we're going to take a look at its performance, it's down 5%. Like I said, $6 lower from here. We're going to be at 1-year low. Forward earnings, it's down 78 times earnings per share. So it's still a little pricey. It's a market cap of $92 billion. So if we're going to take a look at its performance, it actually beat its sales and earnings estimates, Wall Street estimates. So that's a good sign. So now we're going to take a hard look at its real numbers. All right. Okay. So I'm seeing a good number here. Oh, you know what, Huawei? See. Okay. So all this time, Huawei, I was reading the statements in reverse, starting
What
from
were your
Uber. So instead of like, so here, I was looking at 2022 numbers. So actually, Uber gained more business.
Mhm.
So correction on that. I hope our listeners is still sticking around. But
Mhm.
here, 2021 for Uber, and then 2022.
It's
While
on the right hand side.
yeah, Lyft meanwhile is 2022 on the left hand side and 2021 on the right hand side. So it's kind of reversed. So that kind of messed me up right there. So actually, Uber generated at least more than double its sales. So that's a
I see.
relief. So
Oh,
from
okay.
2.9 or 3 billion, it more than doubled to 6.9 billion in sales. So that's pretty good, right? That's pretty good.
Yeah.
A relief right there. Okay. So all this time I was thinking maybe they're they're collapsing or something of some sort. Because that's not really good.
But they're actually doubling.
They doubled their business. So that's a good
Mhm.
sign. Uh their expenses, Uber, we're going back to Uber here. And we got the Lyft correct. So it's Uber and DoorDash that we got mistake. So total cost and expenses is rose almost 3 billion. Um, okay, they still lost quite a huge amount, nearly losing the same amount that they made. 5.9 billion dollars in losses for this quarter. So their cash, it's still about 4.6 billion in cash with more than about 10 billion in debt. So they're still quite leveraged. For DoorDash, they actually grew their revenue by almost 400 million,
Mhm.
but they still delivered a little bit more loss compared to last year at 167 million dollars in loss. Company is cash rich at this point in time, so that's a good sign. So Airbnb, wow, look at this number. It's pretty nice. They're nearly doubled their revenue in the first quarter. So people are definitely booking
Mhm.
using Airbnb app. Their cost and expense climbed by $200 million. So their loss, they were able to trim down their losses from 1.17 billion in losses last year to
Mhm.
18.8 million
Mhm.
losses. So that's a good sign right there. Their cash, they're pretty cash rich, looks like 6.9 billion plus 2.4. That's how much? 6.9 plus 2.4. 9 billion in cash with about, let's say how much that, almost 2 billion here, 63 here, 2 billion in debt. Not bad. So they're pretty much cash rich, this company. Nonetheless, their stock price has suffered big time.
Well, it suffered big time during the pandemic and it
Mhm.
miraculously recovered.
Yeah. So now we're gonna go to our last segment of this podcast. It's a roll the clip segment from none other than Fundstrat's Tom Lee. This was recorded this morning and published this morning. So risk reward for equities has improved this week. Let's roll the clip.
Let's bring it into Fun Stretch Tom Lee now. Get his read on where we stand, where we may go from here. He's on the phone. And Tom, when you were with me the other day on overtime, you were quite honest about, being early or wrong. You said, I believe I have egg all over my face. And I'm wondering now how you feel, whether that egg has now turned into a souffle or where you think we're going now based on that pain we all endured yesterday.
Yeah, hi, Scott. Thanks for having me. It's been very painful. And I think it's clear that not only is our equity markets really nervous and edgy, but they're hyper sensitive to inflationary data. And I think, whether it's FOMC meeting or even today's payroll numbers, it's really about getting some comfort that inflation's breaking. And from our perspective, it's been really painful. And I don't want to sound like I'm trying to be stubborn, but I just think the risk reward for equities here has improved this week. And I know it sounds glib to say, well, it's, everything's 5% lower, that's why you like it. But number one, on the FANG trade, I just think that multiples are still becoming gifts, especially if we have a soft landing or even a recession, because these companies can grow through a recession. But I think people are overlooking things that are actually forward indicators, because today, for instance, the Manheim Used Vehicle Index came out. It's down to a year-over-year growth rate of only 8%. It was 24% last month. Believe it or not, that in 2 months might take up half a point out of CPI. So I'm kind of more in the camp now that I think we can get some softer readings on CPI. It's not necessarily in the hard data yet, but when it does, I think that's when stocks can really find their footing. Yes, it's been tough.
Is that all we need? I mean, look, it's not like you haven't been a Pollyanna about this either. I mean, you said that the first half was going to be treacherous. That's the word that you used. And if anything, it's been even more treacherous than I know you expected perhaps that it would be. Do you still stand, though, with your view that stocks are going to have a good second half of the year, knowing what we know about what the Fed is going to do? And might I also add the fact that there's considerable doubt, and considerable is a light way of putting it.
All right, it looks like the interview got cut off. But yep. So
Still bullish.
he's still bullish overall. Looks like
Yeah. Well, you have to look at the 10 economic indicators, and even up to now, some people are questioning how we calculate the CPI. It's like they're saying we need to update it, right? So we may be getting different numbers. Some are saying it's 13, 14% inflation, but the CPI is just showing 7.8 or 7.9. So it's the way we measure CPI inflation. And some are saying that we should incorporate like earnings with the rise in prices, wages.
Yeah.
So I don't know. We are in a highly technical world right now, and data is the answer, right? So we're
Yeah.
all looking for data.
Data is the key and cash is king.
Cash is king again. Can you believe that? We were just talking about this when was this? 2 years ago? I can't believe it. We're back in the same boat.
Yeah. At one point, I think Bridgewater, who was that? Bridgewater's Ray Dalio said cash is trash, and that's the time that people should have switched to cash and then bought the dip. But regardless, it's been quite a tricky road, at least for the past week, or at least since the start of the year. And if you're still invested, you're not the only one hurting. Everybody is. I shared in the group as well the Total Income Vanguard fund, VTINX. So if I can pull it up right here, it's actually a retirees investment. It has actually returned negative as well since the start of the year. So that's quite a troublesome picture right there for some of the retirees who are, probably trying to keep their investments over there for probably a lot less risky type of return. But it has indeed at least returned 10% since its peak.
Well, speaking of Vanguard funds, check out, Vanguard Market Neutral Fund. It's performing quite well in this downturn.
VMNFX.
FX, I believe. Yeah.
Let's see if it's performance $12 a share. For the past month, it's up 5%. Incredible. Wow.
So I mean, just for our viewers, might be good to look at its holdings.
Since the start of the year, it's up 9.6%. I want to know what it's holding.
Yeah, I looked at it a while ago, and a lot of them are not familiar to me.
Largest
Okay.
holding Axelis Technology, SFL, Now Inc., Virtu Financial. Huh. Interesting picks.
Now, Virtu Financial, I am aware of that. I used to hold it. It's like a market maker. It I think it helps price equities
So it does
uh,
short too.
with trading.
Yeah, it has long and short positions. Number one is PBF Energy, Axelis Technologies, SFL Corp, Virtu Financial, CubeSmart, Extra Space Storage. Short, it's short Chesapeake. Oh,
What?
that's quite interesting. Yeah. They're short
Hmm.
one major oil company right here.
Wow, interesting.
Greenbrier, Switch, they're short Well Tower, which is a big real estate firm as well. Chart Industry, Lumentum, Wallspeed. Yeah, I'm definitely not quite familiar. They're more exposed in financials, industrials, and infotech. How come they're still up? Amazing. Quite a beat right there. 9.6%. Interesting.
But high expense ratio of 1
One
point
point, yeah,
something.
1.18. Interesting.
Mhm.
Well, Wari, I think that does it. We have recorded at least an hour worth of worthwhile discussion among companies that we would think that might, satisfy our investment cravings.
Mhm.
Well, Wari, thank you so much for coming in this evening. It's already 9:24.
Thank you, Mark.
Well, Wari, do you have any quote for the week before we go, or shall we close it here?
Well, I would just like to tell our viewers to stay agile. You know, you're like your own investment manager, and as an individual investor, you have more agility
Yep.
than
Yeah.
than the corporate investment funds.
Yeah. At least stick to your long-term view. Stick to the reason why you bought the stock at the first place. All right. Well, listeners, that does it for this episode of Marky and Wawi Show. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
Ali Santos signing out.